How to trade a low directional bias to the downside. So the low directional bias doesn't mean that there's a lower chance of making a good trade from these arrows. What we do know is that, again, we've moved from the strong range breakout chance, which is the 45 to 55 range, the blue arrows, and we're moving down, again, with the market pushing the direction downwards, looking for that eventual reversal. Okay, so a lot of the times when you're trading the middle calls within the sentiment, you've got that greater chance of the breakout. Okay, because the market will then take an overriding direction and move aggressively in that way. When you're trading the very, very kind of strong reversal, sentiments, the green and red arrows, then the market has already done a lot of this, and you're just getting that final bit of movement in the market before the opposite direction happens and we come back to fair value. So this is after the breakouts have happened, but we're gaining in that momentum, and these can be good trades to ride. So we take an example of the dollar versus the Polish zloty here. I've already got the charts open in the same way as I generally would do. This is the double click H1 chart. I've just overlaid RSI that you get from TradeView just to show you, the basics of how you build up a chart and get this direction. So we see the market has already broke out, which would have been from the blue arrows, and then the market then has continued, to move higher. Okay, so that's the direction of the market. So the reason why the arrows are pointing down is because we're going to be looking to get into that increasing, bear reversal pattern, which comes, very, very high on. So what you think is we've done the breakout now, so the market now is in that final part, very much like an Elliott wave, where the market's trying to push as high as it can before the sentiment, this bull sentiment's reversed, and that's why the arrow's down, because bears are going to be looking for opportunities and they're going to be looking for that imminent bear reversal. So you will get strong moves up, and that's the end of the moves. And what we're looking for is to get the higher points from the market. You see two daily resistance levels here. We break above the 161.8 and the 100%. But as soon as we get as high as that, the sellers then sell the tops. So once we've sold the tops, we're outside the Bollinger Bands on the hourlies. And again, you can see this on the 15-minute chart. We're well outside kind of the kind of fair value here. So the market really wants to kind of get down to these support levels, get back down to, I would say, certainly these daily and weekly points of support down here, so 3.0602. But then what you have to do is be aware that if you're getting short, you might see that final push through before we start getting into the increasing bull sentiment, okay, or the increasing end of the bullish sentiment before that imminent reversal happens. So you look for the market to close below key levels and then get back towards the moving average, towards the lower end of the range. As you can see from the RSI, we've hit the 70, over bought level. The market's made a double top, so realistically the market wants to get back down to the 50%. Okay, and that's going to drag the market down to these lower levels of support. So it's not to say the low edge directional bias on the upside or downside are not good trades. It's just to say that you have to be careful that you're getting conflicting messages. So we can see the overriding sentiment, see that quick snap, or you can see other people and other market participants getting involved in the market and seeing these highs and then pushing the highs down, looking for that bigger long-term move before the market then sells off, then comes back to the overall opposite end of the scale, which would be the imminent bear reversal, and we see that quick snap back with buyers, hitting the extremes of the market.